Back with Colin Stewart. He says quality companies are on sale in Canada. We were looking Friday, saw a whole bunch of banks, for example, hitting 52-week lows.
Yeah, it's become pretty widespread. Obviously, I think many asset prices across many different markets have been repriced because of this huge increase in the risk-free rate we've seen in the last 18 months, and that's understandable. Typically, as the risk-free rate goes up, you have to use a higher discount rate to discount back those cash flows for any business. So any business should trade at a lower multiple. I think the surprising thing that we've seen in recent weeks is that the impact in the Canadian market and some of the other secondary markets has been particularly striking. And on the other hand, I would say U.S. large cap stocks have actually held up quite well. So there's some evidence that certain areas of the market, sort of the haves and the have-nots, have not really been that impacted by this rise in the risk-free rate. For example, U.S. tech stocks have been quite resilient, as we know, and still trade at fairly high multiples. But on the other hand, many Canadian businesses we're seeing are very, very cheap, and in some cases trading at whether a multi-year valuation low, and in some cases I would say even a multi-decade valuation low. So you mentioned, Andy, the banks. I think other companies in Canada or other sectors we're looking at, utilities are under a lot of pressure. Some of the telecom companies, Rogers and Bell, both under a lot of pressure. And I think, as I said, many, high quality Canadian businesses that I would say, if you look at the share price and you look at their underlying business fundamentals, there's a very large disconnect there where the underlying businesses are pretty stable, steady cash flow, but the share price is down a lot.
You have some ideas for us. Jamieson Wellness, the giant in vitamins and supplements, they did a big U.S. acquisition. I think some investors are waiting for that one to play out.
Yeah, they did last year, and I think there was some skepticism around that initially, but the last quarter they reported actually saw pretty strong results from that U.S. business they bought. And as you point out, they're the largest vitamin brand player in Canada, growing business in the U.S. and China, and you can't come across too many businesses that are more steady and stable than a vitamin business, not overly economically sensitive, pretty recession resistant, steady cash flows, nice dividend yield just over 3% today, and yet the share price is down, I think, over 30% year to date. And a lot of that has not been, expectations that earnings are going to come down. It's just been the market repricing it at a much, much lower valuation multiple. So there's a great example of a business we own, we've been buying more of, very high quality and trading at the lowest multiple it has I think actually since it's come public in the last 8 or 10 years.
We got